Are you retired or approaching retirement? Then stop what you're doing, because what I'm about to share could save you thousands of dollars this tax season. Right now, thousands of seniors across America are unknowingly handing the IRS money they were never supposed to pay. We're talking about a $5,000 mistake, and the worst part, most people don't even realize they've made it until it's too late. Here's the truth nobody tells you. The tax code actually has special protections built specifically for seniors, deductions, exemptions, and credits that can dramatically reduce what you owe. But if you don't know they exist, you'll never claim them, and the IRS certainly isn't going to remind you. We're talking about overlooked deductions on Social Security income, medical expenses that most seniors completely miss, property tax exemptions that your state wants you to have, and that's just the beginning. I've seen this happen to smart, hard-working retirees who spent decades doing everything right, only to overpay the government simply because of a few blind spots on their tax return. Whether you're filing yourself or trusting someone else to do it, you need to know this information. In this video, I'm breaking down exactly what the mistake is, who's most at risk, and the simple steps you can take right now to protect your retirement savings. If this is valuable to you, and trust me, it will be, smash that like button right now and let's dive in. Let's start at the very beginning because I want you to fully understand the scope of what's happening here. Every single year, the IRS collects billions of dollars in taxes that seniors legally did not owe. That's not a conspiracy theory. That's not an exaggeration. That's a documented pattern that tax professionals and financial advisors see over and over again, year after year, across every state in this country. Now, why does this happen? How is it possible that so many intelligent, responsible people who worked hard their whole lives, who raised families, who built careers, end up writing a check to the government for more than they legally have to? The answer is surprisingly simple, and honestly, it's not your fault. The American tax code is one of the most complicated documents in existence. We're talking about thousands of pages of rules, exceptions, sub-exceptions, phase-outs, thresholds, and special provisions. No regular person is expected to know all of it. That's why accountants and tax lawyers have entire careers dedicated just to understanding it. But here's the thing. Buried deep inside that complicated tax code are specific provisions that were written specifically to help older Americans. Congress has actually tried, over the years, to give seniors a little bit of relief. There are extra deductions for people over 65. There are special rules around retirement account withdrawals. There are exclusions for certain types of income. There are credits specifically for low to moderate income retirees. These things exist. They are real. And millions of seniors every year fail to claim them simply because they don't know about them. Think about that for a moment. The law was written to help you, but if you don't know the law, you can't benefit from it. And so seniors end up donating money to the federal government, not out of generosity, but out of ignorance. And I say that with complete compassion because the system is designed in a way that makes it almost impossible for the average person to navigate without help. What makes this especially painful is that we're talking about people who are on fixed incomes, people who are watching every dollar, people who are deciding whether to turn the heat up or save a little extra for a medical expense. $5,000 to a retired person living on Social Security and a modest pension is not a small number. That's months of groceries. That's a car repair. That's a plane ticket to visit grandchildren. That money matters, and you deserve to keep it. So let's talk about exactly where the money is going, the specific mistakes that are draining your wallet without you even realizing it. The first big mistake, and honestly, the one that shocks people the most when I explain it, is how Social Security income gets taxed. A lot of people believe that Social Security is tax-free, and for many years, for many people, it was. But that changed decades ago, and the rules are still confusing people today. Here's what you need to understand. Whether your Social Security benefits are taxable and how much of them are taxable depends on what the IRS calls your combined income. Your combined income is your adjusted gross income plus any non-taxable interest you earn plus half of your Social Security benefits. If that number stays below a certain threshold, your Social Security is not taxed at all. But once you cross that threshold, up to 50% of your benefits can be taxed. And if you're above a higher threshold, up to 85% of your Social Security can become taxable income. Now here's where people make the mistake. They assume that because they're not rich, this doesn't apply to them. They think, I'm just a retiree living modestly. Surely I'm not going to get taxed on my Social Security. But the income thresholds for this haven't been adjusted for inflation in a very long time. What that means in plain English is that these thresholds, the cutoffs that determine whether your Social Security gets taxed, are essentially stuck in the past. And as prices have risen and retirement account balances have grown, more and more ordinary middle-class seniors are crossing those thresholds without realizing it. If you're taking distributions from a traditional IRA or a 401k, that counts as income. If you have a small pension, that counts. Even some investment income counts. All of that gets added together with half your Social Security, and if the total is higher than those old thresholds, suddenly a big chunk of your Social Security benefit is taxable. Many seniors find this out for the first time when they get their tax bill, and it's a nasty surprise. The fix here isn't to stop taking money out of your retirement accounts. You may need that money to live. But there are strategies that can help manage this. Things like understanding exactly what your combined income number looks like and planning your withdrawals in a way that keeps you below the tax trigger. Some people also consider strategies involving Roth conversions in the years before they start collecting Social Security, which can dramatically reduce their taxable income in retirement. This is complex stuff that really benefits from professional guidance, but the important thing to know is that there are options. And the worst thing you can do is just accept a big tax bill without investigating whether you could have avoided it. Now let's talk about the second mistake. And this one is so simple that when I tell people about it, they almost can't believe they missed it. It's the extra standard deduction for seniors, and it is one of the most consistently unclaimed tax benefits out there. Most people know about the standard deduction, the flat dollar amount you can subtract from your income before calculating your taxes. For 2024, for a single person, that's a pretty generous number. But what a surprising number of seniors don't know is that once you turn 65, you get an additional standard deduction on top of the regular one. And if you're married and both you and your spouse are 65 or older, you both get that extra deduction, which means it doubles. It doesn't sound like a fortune at first glance, but think about what it means in practice. That extra deduction directly reduces the amount of income the IRS taxes you on. So if you're in even a modest tax bracket, that extra deduction is putting real money back in your pocket every single year. Here's where people go wrong. Sometimes they work with a tax preparer who just punches numbers into software and doesn't take time to make sure the senior checkbox is correctly marked. Sometimes people file on their own and genuinely don't know the extra deduction exists. And sometimes people actually choose to itemize their deductions instead of taking the standard deduction, thinking they'll come out ahead, but they've done the math wrong and actually end up paying more than they should. It's a more common error than you'd think. The bottom line is this. If you're 65 or older and you're not sure whether your tax return is correctly claiming that extra standard deduction, it's worth a second look. Ask your tax preparer to confirm it. If you file on your own, double check that you've indicated your age correctly on the return. It's a small thing that makes a surprisingly big difference. This third mistake might be the most expensive one on the list because medical costs for seniors are often staggering. And yet the deduction for those costs goes unclaimed at an alarming rate. Here's how it works. If your qualified medical expenses exceed a certain percentage of your adjusted gross income, the amount above that threshold is deductible. Now, when healthy young workers hear this, they often can't use it because they don't spend enough on healthcare to hit that threshold. But seniors? Seniors often have significant medical expenses. We're talking about Medicare premiums. Yes, those are deductible. Supplemental insurance premiums, prescription drug costs, dental work, vision care, hearing aids, home health care expenses, if you need assistance, physical therapy, even travel costs to and from medical appointments in some cases. These expenses add up in ways that are genuinely surprising when you actually sit down and total them all up. A lot of seniors go through the year paying these costs out of pocket, and they never think to track them, document them, or connect them to their tax situation. And so when tax time comes, all of that money is just gone, paid out with no tax benefit whatsoever. The mistake here isn't just failing to claim the deduction. It's also failing to keep records that would allow you to claim it even if you wanted to. If you haven't been keeping receipts, statements, and records of your medical spending throughout the year, it becomes very difficult to reconstruct that information accurately when you're sitting down to file. Starting right now, I want you to create a simple system for tracking your medical expenses. It doesn't have to be complicated. A folder, physical or digital, where you put every explanation of benefits from your insurance, every prescription receipt, every doctor bill, every statement for any kind of medical service. At the end of the year, you or your tax preparer can total it all up and see whether you hit the threshold for a deduction. For many seniors, especially those dealing with chronic conditions, multiple medications, or ongoing treatments, the numbers are well above the threshold, and the deduction is substantial. Don't leave it on the table. Now, here's something that a lot of people overlook entirely when they think about their tax burden, and that's the state and local tax benefits specifically designed for seniors. We spend so much time worrying about federal taxes that we completely forget there's a whole other layer of taxation happening at the state level and a whole other set of potential savings sitting right there waiting for us. Every state is different, but the majority of states offer some kind of special consideration for senior citizens when it comes to taxes. Some states exempt Social Security income from state taxes entirely. Some states have special exemptions for pension income, military retirement pay, or retirement account distributions. Some states offer significant property tax relief programs specifically for older homeowners. That last one, property tax relief, is one of the biggest missed opportunities I see. In many states and many counties, there are programs specifically for senior homeowners that can dramatically reduce your property tax bill. These programs go by different names. Some are called homestead exemptions, some are called senior freeze programs, which lock in your property's assessed value so it can't keep rising year after year. Some are direct rebate programs where the government actually sends you a check to offset what you've paid in property taxes. But here's the brutal truth about these programs. They almost never automatically apply to you. You have to apply for them. You have to know they exist, find out how to enroll, submit the application, and sometimes renew it every year. Local governments are not in the business of proactively reaching out to seniors and saying, "Hey, you're eligible for this benefit, let us help you save money." You have to go find it yourself. And sadly, so many seniors never do. They've owned their homes for 30 or 40 years. They're paying property taxes every year, and right there in the county assessor's office is a program that would cut their bill significantly, and they don't even know it exists. So after this video, I want you to do one specific thing. Go online or call your county assessor's office and ask them, point blank, what property tax exemptions or relief programs are available for seniors in my county? That single phone call could save you hundreds or even thousands of dollars every single year for as long as you stay in your home. This fifth mistake is one that hits people who have traditional IRAs, 401ks, or other tax-deferred retirement accounts. And it's a mistake that can be brutally expensive if you're not paying attention. When you have money in a traditional tax-deferred retirement account, the IRS has been patient with you for decades. They let your money grow tax-free, but at a certain age, they say enough is enough. You need to start withdrawing money from that account, and you need to pay taxes on it. These mandatory withdrawals are called required minimum distributions, or RMDs. The rules around RMDs have changed in recent years. The age at which you have to start taking them has been pushed back, which sounds like good news, and it is to an extent. But it's also created new confusion because people who thought they understood the rules are now working with outdated information. Here's where people make costly mistakes. The first mistake is simply not taking the RMD at all, or taking it late. If you miss your RMD deadline, the IRS can hit you with a penalty that is a significant percentage of the amount you should have withdrawn. That's a massive penalty, and it gets assessed on top of whatever income tax you would have owed on the withdrawal anyway. The second mistake is taking too little. If you calculate your RMD incorrectly and withdraw less than the required amount, the same penalty applies to the shortfall, and calculating RMDs is genuinely complex. It involves your account balance at the end of the prior year, a life expectancy factor from IRS tables that changes annually, and if you have multiple retirement accounts, you have to do separate calculations for each one. The third mistake, and this one is a little sneakier, is not thinking strategically about how your RMDs interact with the rest of your tax situation. Your RMD is taxable income, and depending on how large it is, it can push you into a higher tax bracket, increase the amount of your Social Security that gets taxed, or even affect your Medicare premiums through something called IRMA, the Income-Related Monthly Adjustment Amount, which causes higher income seniors to pay more for Medicare Part B and Part D. The good news is that with some advanced planning, many of these downstream effects can be managed or reduced. But you have to be proactive. You can't wait until you get your tax bill and then be surprised by it. The planning has to happen before the year is over. Now let's talk about a credit that sounds like it's only for young people saving for retirement, but actually applies to some seniors as well. It's called the Retirement Savings Contributions Credit, and it's one of the most consistently overlooked benefits in the entire tax code. This credit is designed to incentivize people with lower and moderate incomes to contribute to retirement accounts. If your income falls below certain thresholds and you make contributions to an IRA or a workplace retirement plan, you can get a credit, not just a deduction, but an actual credit that reduces your tax bill dollar for dollar, worth up to 50% of your contribution. Now you might be thinking, I'm already retired, why would I be contributing to a retirement account? But here's the thing, if you're still working part-time, or if your spouse is still working, you may still be eligible to contribute to an IRA. And if your combined income is under the limits for this credit, you may be leaving free money on the table every single year. This is another one of those cases where the tax code was written to help you, but it only helps you if you know it exists. And because it's not as well known as some of the other senior tax benefits, it flies under the radar constantly. Tax software will sometimes catch it, but not always. And if your income is right at the edge of the eligibility threshold, it's worth doing a careful analysis to see whether you qualify. Here's one for the generous souls in our audience, and I know there are many of you, because seniors are among the most charitable demographic in America. If you're 70 and a half or older and you have a traditional IRA, there's a powerful tax strategy available to you that most people have never heard of. It's called a Qualified Charitable Distribution, or QCD. Here's how it works. Instead of taking money out of your IRA, paying taxes on it, and then donating what's left to charity, a QCD lets you transfer money directly from your IRA to a qualified charity, up to a generous limit per year. And it counts as a tax-free distribution. The money never passes through your hands. It goes straight to the charity, and you never pay income tax on it. But it gets even better. If you're at the age where you're required to take RMDs, a QCD can count towards satisfying your required minimum distribution for the year. So instead of being forced to take a taxable distribution, you can satisfy your RMD requirement through a charitable contribution, without the tax hit. For seniors who are charitably inclined anyway, people who give to their church, their alma mater, a local hospital, a food bank, this is an extraordinary opportunity. You're giving the same money you were going to give anyway, but instead of paying taxes first and then donating, the full amount goes to the charity tax-free. It's a win for you and a win for the organizations you care about. The catch is that it has to be done correctly. The check has to be made out directly to the charity from the IRA. It cannot go to you first, and there are specific types of charities that qualify. But if this sounds like something that might apply to your situation, it's absolutely worth exploring with a tax professional. At this point, you might be nodding along and thinking, okay, this is interesting, but is it really that big a deal? Let me put some real numbers around this because I want the weight of this to sink in. Let's say you're a retired couple, both 68 years old. You have Social Security, a small pension, and you're taking RMDs from a traditional IRA. Let's say you're missing the extra standard deduction for seniors. That's costing you something. Let's say you haven't applied for your county's Senior Property Tax Freeze program. That's costing you more. Let's say you've had significant out-of-pocket medical expenses this year that you didn't track and therefore didn't deduct. That's costing you even more. And let's say your RMDs are being managed in a way that's inadvertently pushing up the taxable portion of your Social Security. Well, now we're really talking. When you add all of this up, it is genuinely not unusual for a retired couple to be overpaying their combined federal and state tax obligation by $3,000, $4,000, or $5,000 in a single year. And because most people do roughly the same thing year after year, the same filing approach, the same habits, the same blind spots, this isn't a one-time error. This is money leaving your household every single year, year after year, for as long as you're retired. Over a decade of retirement, that's $30,000, $40,000, $50,000 or more in taxes you didn't have to pay. And that's money that could have gone toward your health, your comfort, your family, your experiences, your security. That's a real number with real consequences. I'm not saying this to scare you. I'm saying this because I want you to feel the urgency of looking at this carefully. Because the fixes aren't impossible. They're not even that complicated once you know what to look for. The problem is almost never that the solution is too hard. The problem is that people don't know the problem exists. So let's end this video with something concrete and actionable, because information without action doesn't help you. Here's exactly what I want you to do after you finish watching. First, pull out your last tax return, or ask someone to help you get a copy if you can't access it easily. Look at it with fresh eyes and ask, does this return reflect everything we just talked about? Is the extra standard deduction for seniors showing up? Are medical expenses documented and accounted for? Is Social Security income being handled in the most tax-efficient way possible? Second, if you work with a tax preparer or accountant, schedule a conversation with them specifically around senior tax strategies. Don't wait for tax season to have this discussion. The best tax planning happens throughout the year, not in a rushed April meeting. Ask your preparer directly, am I taking advantage of all the tax benefits available to me as a senior? A good tax professional will welcome that conversation. Third, if you don't currently work with a tax professional and you've been filing on your own, I want to encourage you to consider whether that's still the best approach for your situation. There's nothing wrong with filing your own taxes when your situation is simple. But retirement tax situations are often not simple. Between Social Security taxation, RMDs, pension income, investment income, Medicare premium implications, and state-specific rules, the complexity adds up quickly. The cost of professional tax help is often a fraction of the savings a good preparer can find. Fourth, contact your county assessor's office about property tax relief programs for seniors. Do this even if you think you already know everything available in your area, because these programs change and new ones get added, and many people who think they're enrolled in everything discover they've been missing something. Fifth, start keeping better records today. Medical expenses, charitable contributions, any expenses that might be deductible, keep them documented. At the end of the year, you want to be able to hand your preparer a complete picture of your financial life, not try to reconstruct it from memory. And finally, share this video. I mean that sincerely. If you have a parent, a sibling, a friend, a neighbor who is retired or approaching retirement, send them this video. The information we covered today isn't complicated once you know it, but so many people don't know it. And the cost of not knowing is thousands of dollars a year. If this video helps one person realize they've been overpaying and motivates them to get a professional to take a second look, then it's done its job. I want to close with this thought. You worked your entire life for the money you have. You paid into the system. You followed the rules. You built something for yourself and your family. And now in retirement, the last thing you should be doing is giving any more of that money to the government than the law requires. Not $1 more. The tax code has tools to help you. They're there. They're waiting. You just have to know where to look, and now you do. Take this information seriously, act on it, and protect what you've worked so hard to build. Thank you so much for watching. If you found this video valuable, please give it a like. It really does help this content reach more people who need it. And if you want to keep learning about how to protect your money in retirement, make sure you're subscribed and hit that notification bell so you don't miss anything. I'll see you in the next one.